the idea, I mean, in order to retire or to become financially free, I mean, I make a difference between retiring and becoming financially free, because you could be financially free and you could continue to work if that's what you want. So I mean, that's perfectly fine. In fact, you shouldn't retire if you can still work and be productive, because there are multiple studies that have that basically show us that if you stop working, the quality of your life will start deteriorating, your mental health will deteriorate. So it's always best to continue working if you could still continue. I mean, even if it's like, I don't know, maybe you're working for a charity, or maybe you're doing something that you like. It doesn't really matter as long as you continue being productive. That's the point. So anyway, getting back to your thing.
Two very different things. I mean, two very different things.
Exactly. So the idea is, what exactly do you need to become financially free? The general rule of thumb, if you have a portfolio of 25x or 25 times your annual expenses, you should be okay to retire. I was explaining this earlier with a smaller group, that this is just a rule of thumb. That doesn't mean that, what about, I mean, should I stick to 25? I personally aim for 30, because it gives me some additional peace of mind. Now, why do we need 25 times? Because it's the reverse formula of 4%. The idea is, if you can withdraw 4% per year, or actually the first retirement year, then you're good. Because there are studies that were done on 30 plus rolling years in different kind of economic conditions, and they found that whatever the case might be, even in the worst case scenario, if you withdraw 4%, you have more than 98 to 99% chance of your portfolio to last for at least 30 years. In some cases, it could last more than just 30 years. In some other cases, it basically just failed around the 30-ish year. So that's a safe, that's why we call it a safe withdrawal rate. But like I said, it's always good to be flexible in case, I mean, the market, if the market tanked on the first couple of years of your retirement, you should be able to either supplement your living by, some sort of passive income, or if you have saved more than you actually need, that gives you another buffer, and basically that's your peace of mind. So that should give you the peace of mind. That takes care of inflation, because the idea is the portfolio, in theory, should continue to grow at 7% or by 8%. So if you withdraw 4%, then you still have leeway for inflation and whatnot. So that's the general idea. Now, okay, I think I know where you're going with this. Should I consider 25 times my current annual spending? The answer is no. So basically, you need to factor in inflation. For example, let's say that today my annual expenses are $40,000 per year. I'm just throwing a number. I mean, it doesn't necessarily have to be this, but let's say that it's $40,000 per year. So which means if I need to multiply this by 25, so I need to accumulate $1 million in my portfolio. But this is assuming I'm retiring today. But what if I'm retiring in 20 years? Would those $40,000 be enough to cover my expenses? The answer is no. So therefore, you need to factor in inflation. I mean, there are some calculators. So you take those $40,000 that are enough, or let's say that should be enough for you today, and then you factor inflation in the next, say, if you want to retire in the next 15 or 20 years or whatever, just choose your time frame, and then you calculate what would be the equivalent of $40,000 today in 20 years or in 15 years time, and then you multiply this number by 25, and this is going to be your target number.
Along with inflation, as you just said, 7%.
That's correct.
So it should take care of that.
Correct. But in order to say that, okay, I have reached the point where I can retire, your nest egg or your investments need to be 25 times your actual or your current expenses. So for example, if today I do the math and I realize that I need 40,000 or 20,000, whatever that number is per year. So if I want to retire in 20 years, you have to factor in inflation. Let's say the 20,000 years today would be again, I'm just doing like quick math here, would be probably 29,000 in 20 years or in 15 years. So you have to multiply this 29,000 times 25, and then this is your target number for retirement, and not the 20,000 times 25 today. Because again, unless you're retiring today, if you want to retire today, then by all means, multiply your current expenses times 20, annual expenses times 25, you're done. And we're back to the previous question.
Yeah.
Would you feel okay having all your eggs in a single basket?
So I understand that assets are segregated, so even if interactive brokers goes bust, your assets are safe. But there will be some sort of delay between you can get your assets back, I guess, because they will.
Yes, yeah, it's a lengthy process. Yeah, it's not overnight. I agree with you. So again, there are multiple levels. I mean, it's a personal thing. I mean, I'm okay to keep all my money in it with a single broker, but you might not. So is it wrong to split this across multiple brokers? Again, nothing wrong in that. I mean, you could take it a step further. For example, instead of investing everything in, let's say, VWRA, you might want to split between VWRA and I don't know, IWDA, which is the iShares equivalent, which is like the word fund. Is that necessary? No, but if that gives you peace of mind, by all means, do it. So different brokers, different account, different ETFs, different fund managers. You can go crazy if you wanna be, if you wanna assume the worst case scenario. Do I do it? No. Can you do it? Absolutely, if that gives you the peace of mind you're looking for.
Another question regarding the VWRA. There's also WSML, small cap index fund, right?
Correct.
In your case, have you invested in small cap investment, or it's not something?
Okay, so this is a tricky question, because what I usually advise is just keep everything in a one world fund, keep it simple. Now, in all honesty, and full disclosure here, I do invest myself in a small cap. Does it work? Am I doing better than the rest of the market? If I look at the last 7 years, probably not. I actually did worse than you guys. I mean, than someone investing in VWRA. But why do I choose to do that? Because I believe that in the long term, I mean, over the very long term, small cap has its value. But I still never recommend this for others. Keep it simple, because this is a bet I'm doing. It might work, it might not. So why do you want to bet on something that might or might not work? Just keep it simple, stick with the word fund, and you're good to go. Because at the end of the day, even if, let's say, for whatever reason, small cap, by the way, maybe I'm talking Chinese for others, small cap means if you're investing in small companies and not the word fund. So there are studies that showed over the last 70 years, small companies have done better than larger companies. It's a little bit controversial, but it's true. Now, will it continue performing well? Maybe yes, maybe no. So again, you are making a bet that might or might not pay off. So is it really worth betting on something that might or might not work out? To me, I said, you know what, I'm gonna make that bet, although maybe it won't end up being, performing as well as I'm expecting it to, but I'm taking the bet. But do I recommend that you guys take the same bet? Probably not.
And which small cap? Is it US small cap or global?
No, it's global small cap. WSML, I think, right? So it's the iShares global small cap or something like that.
Because there is a guy, I think Paul Merriman.
Well, actually, that's why. I mean, I used to be a huge fan of Paul Merriman, and he actually swears by small cap value in the US. And yes, it had performed well over the last probably 70 years. But if you look historically over the last 25 years, it wasn't doing anything. So there are two theories. Again, maybe we're digressing here. I'll wrap it up real quick. There are two theories. One theory that says that maybe the times of the small cap is over, because now that people have discovered how it works, it's no longer working, right? And there's another theory that says maybe now it did not perform well over the last 25 years, but guess what? Over the next 25 years, it's gonna perform well. Which one is right? I have no clue. I made a bet, it might or might not work out. So is it really worth doing it? Totally up to you. But I don't recommend anyone to do any special bet against the market. Just because at the end of the day, even if small cap is going to perform well, you're going to probably squeeze another 0.5% per year over the long term. Is that going to make or break your retirement? Not really. And again, let me put this in another perspective. In 25 years, does it really matter if I have $1.5432 million or $1.478 million? It doesn't really matter in the grand scheme of things. So we're really splitting hair here. But since I'm a numbers maniac, so to speak, that's why I'm into it. Yes, please.
What's the difference between going for something like a VWRA where you have access to global stocks or just something that is S&P? Because a lot of those big companies are global anyway.
That is the theory of John Bogle or Jack Bogle. He used to say you don't need world stock because the S&P 500. I mean, if we look at the S&P 500, Microsoft, Google. I mean, they're here in the Middle East, they're in Japan, they're in Europe, they're everywhere. But then again, if you look at the stock market between 2000 and 2009, the S&P 500 was totally flat. Actually, it went down, but over the 10 years, it was flat. However, if you look at the international markets, they weren't flat. They made some money. So does it mean that I have to? I mean, I personally don't like to concentrate all of my eggs in a single basket, which is tied to the U.S. economy and to the U.S. dollars. This is very important because to me, I'd rather have a basket which is globally diversified, even though the majority of companies in the S&P 500 are global anyway. That's me. Again, there's no right or wrong, but that's what I would choose.
What are the other advantages for interactive brokers over SARWA?
Quite honestly, it's just the long-term fees. Basically, because now today you're paying between 0.5 to 0.85, depending on the size of your portfolio. 0.5, and there's another thing. SARWA invests in US domiciled funds. Now, if you invest in general, I mean, in a vacuum, if you invest in US domiciled funds, there are two caveats here. Number one, they take 30% of withholding tax on the dividends, which is something you can save on if you're investing in Irish funds like VWRA. So instead of paying 30% in taxes, you pay a reduced 15%. So that's one. Number two, which is the nasty one, if, for example, if I'm investing in US domiciled funds and I get hit by a bus, 40% of my money, which is above $60,000, will evaporate in what we call them estate tax, which is inheritance tax, US inheritance tax.
With SARWA, they're saying this is
correct. With SARWA, you are protected because they have a legal structure that protects you. Well and good, but still you are paying those 30% taxes on the dividends. Now, however, on the other hand, you might tell me that, you know what, SARWA has a selection of ETFs, and by the way, it has an excellent selection of ETFs. The expense ratios on these are close to 0.08 or 0.05%, so it's like dirt cheap. However, if you factor in the withholding tax, these ETFs will end up costing much more in terms of expense ratio than the equivalent VWRA, which is 0.2, I believe, or 0.22 or something like that. So the thing is, you are paying more. So you're paying, let's say, close to 0.40% in terms of ETF fees. Add on top of that the 0.5 or the 0.8, and then you have reached close to 1% in fees. Now, over the short term, for a small portfolio, it doesn't really matter that much. But over, let's say, 25, 30 years with $1 million plus portfolio, it starts to
around $200,000.
I'm totally with you on that.
Yeah.
Nothing wrong with this. Like I said, if for you need a complete hands-off approach, by all means go with SARWA. I mean, I recommend SARWA for anyone who's starting, because what I see, the kind of questions let me ask you something here. Is there anyone who is not investing just yet? Don't be shy. Just raise your hands.
Actually, I was thinking to ask how are they planning their budgets, because this is very important as well. It's a basic one, but maybe
Yeah,
there
sure,
are
sure.
people-
But before we reach the budget, so I could see like quite a few hands. I'm pretty much sure there are more, but they are a little bit shy. That's fine. My point is, for those who are shy, I mean, for those who are too scared to start, just start with SARWA. Because I mean, by the time you say, oh, you know what, I want to optimize my transfer cost and I want to get everything right from the get-go, this is a waste of time. Just start with SARWA. It doesn't matter. Start now, optimize later. I keep saying this all the time. I will take it to the next level. You could start with SARWA and stay with SARWA until the end of times. Nothing wrong with that. Yeah, you might save more if you do it yourself, but it's not going to be that huge difference, even after 20 years or so, because you have to factor in. I mean, there are multiple factors. If you're doing it with SARWA, you're making a local transfer, right?
Local, yeah,
every
exactly.
month.
But then again, what is the US dollar rate that you're paying? You don't have to answer me. Just you have to keep this in mind. The spread between the currency spread. That's one. Two, if you're doing it yourself via IB, you have your transfer costs, which could be very low if you're with HSBC. By the way, the banks keep changing the rules, so I'm not sure if you're still able to transfer dirhams with HSBC. There are multiple banks that stop that. NBD, I mean, Emirates NBD used to have that, but from what I heard, they stopped it. So sooner or later, I believe, sooner or later, banks are gonna stop that. And if it's still working with HSB, great. But sooner or later, I believe it's gonna stop. It's not gonna last forever. So at some point in time,
allowing if you have a US dollar account, you cannot transfer from your US dollar account to IBKR.
you can. But the thing is, do you have any idea what is your transfer rate or your exchange rate?
It's I think it's about 3.7 the 3.69. So they're just
Really?
Yeah, exactly. That's what they charge me.
3.69 is actually good.
Yeah, it's very good.
So that's
3.69 is actually good.
I've done it too.
I mean, I personally use
Wall
oh God,
Street.
Wall Street, and Wall Street gives me 3.675, which is awesome.
Yeah,
3.67, sorry, 3.6735. That's the exact number. It's great, but then they charge a fixed fee of about 150 dirhams or so, depending on the amount you're transferring. So therefore I don't transfer on a monthly basis, because I mean 150 per month is quite steep. So I wait 3 months or so, and then I make a huge transfer with a single 150 dirham fee.
I think HSBC expat still makes it for free. They said expat accounts.
Probably, I don't have an expat account with HSBC, but yeah, I heard, but I'm not sure, because things keep changing with the banks. So that's why
You never know when
we're
they-
always
yeah.
chasing our tails when it comes to banks.
Can I just
Yeah, sorry.
the answer if we are able to transfer from ENBD to IPOs? Has anyone had success with it?
Dirhams, you mean?
Yeah.
Let's ask the question. And
105 grams, but you can do it.
Are you able to do it?
Yes, yes. Actually, you can transfer grams itself, and then you.
Yeah, I know. I wanted to like.
hi, how are you?
Thank you so much.
Join us here.
Yeah, it's cool. I've got my
And what about the
Thank you.
cost? Like rates? What about the rates? Are they good?
Rates, you get the Forex rates. You can transfer it on the IBKR, so it will be the Forex rate. It will be the best rate because it's the online Forex rate which you get. So for that, they are charging $4 only. When you transfer whatever amount you are going to transfer, the transaction cost will be $4.
Okay, and then on top of that, you will have 100 and
150 is ENBD charges.
okay.
Emirates NBD charges will be 150 grams. 105 grams. I think.
Yeah, do any brokerage.
So again, these are all optimization tips, and it might sound a bit overwhelming for those who are just starting. Don't worry about, I mean, for those who are starting, don't worry about any of this. Just make a bank transfer. Even if it costs like 150 dirhams or whatever the case might be, just do it. Because sometimes I see people like debating or whether they should transfer via HSBC or whether via Wise, or just to save a few. I mean, it's great to save some money here and there, but by the time you're doing those calculations, the market has already, the market went up, and you would have made much more if you just invested that money instead of waiting and trying to optimize another 10 bucks here or there. So always think big. Start now, optimize later. So just do whatever works for you. If you want the easiest option, start with SARWA. It's totally hands off. Over the long term, yes, you could save a bit more if you do it yourself. But if you give me the choice between starting with SARWA today, and by the way, you just pull your phone, you scan your Emirates ID, in 15 minutes your account is up and running, right? Versus having to wait and debate whether I should transfer via HSBC or via Emirates NBD or whatever the case might be. I would rather start with SARWA today. And by the way, I'm not affiliated to SARWA. I don't get anything. Yeah, I've been hosted on one of their what do you call that, podcast kind of, but I'm really not affiliated with SARWA. I just happen to believe that they're one of the good people, because apart from that, all I see here in the country is, you know, if you look at those trying to sell you those long-term saving plans. And by the way, I was victim myself, and I had not just one, not two, three of these saving plans. So imagine 3 saving plans that cost me an awful lot, and that was my tuition to my, or that was my tuition to my financial literacy. It was a very expensive one, I'll tell you that. A very expensive one.
People before they are starting, they think about the charges that they never start. So as you said, it's the right thing. Whatever, even if it costs you 5% of your capital, also you start it. Once you start it, then you will come to know how to
Exactly,
do it.
exactly.
Then
Get the
start
momentum.
optimizing, because otherwise you will never start. You'll maybe lose after 5 years. You think, oh, I could have started like 5 years back.
And the typical thing that I hear, I'm afraid to start because I'm afraid to make a mistake. Make mistakes,
Correct.
because the biggest mistake is not starting. Trust me on this one.
Can you talk about the mistakes? Is it just one question and recorded event?
Are we recording? I
just-
think Wali is recording it unofficially, but this is not SimplyFI. So
No, not going for it.
so no, we're not
No,
recording.
maybe we'll put up on the page some of the clips.
Yeah, why not? Why not? I will have to. Do we have Muzammil here? Oh, I didn't see you. Sorry, man. Yeah, he's hiding in. Well, you guys should, you must know Muzammil. He's part of the SimplyFI moderators and board of what do you call ourselves? Board of what? Governance board. Yeah, there you go. By the way, SimplyFI is not our group. It was founded by Sebastian like 8-9 years ago, I think. And but he's no longer active on the group. He's back to Belgium after he retired in just 7 years. So he started by age 26, retired by age 33. So yeah, it's feasible. It's not for everyone, but it's feasible.
Yeah, Sebastian has moved on. So.
Now he has Fire Belgium, which does that, which is for people in Belgium.
There's one thing which everyone has to consider for themselves. It's the country from which you belong to. Like for India, because I just shifted to Dubai 2 months back, there are a lot of taxes which, based on the way your money is being routed, a lot of taxes Indian government can charge you. So for everyone's home country, it will be different. Additionally, like maybe some of you shifted here 5 years back, 7 years back, or maybe someone like me just shifted 2 years back. You have to also think what happens to your money in India, like in your home country. Because let's say if I keep all my money which is in India, then I have a lot of taxes to pay on it. Versus if I withdraw it, and then again the question is how do you withdraw? What are the tax laws? When do I withdraw and shift it to UAE? All of that will start coming into play.
And repatriation tax is also there now in India.
No, in India,
And
actually,
You can do.
till now I'm not at that level that I thought to move my money from India to here. But yeah, I worked there for 8 long years. There's a lot of saving there also. Plus, based on real estate, if you have any real estate in India, and then where are you planning to retire? These things might not matter for some of us, but when I just thought taxes to put things in numbers, 5 million a year investment in Dubai versus 5 million INR, I'm saying, investment in India can make me off by around 240 million Indian rupees in the next 20 years. So it's just for Indians. For all other nationalities, you'll have to check for yourself how does it work.
Actually, that's a good point, because everyone comes from a different country, and the tax laws are very different for each. And it gets even more complicated if you're married to someone from a different nationality. So this is when things gets a little bit more complicated. And if one of the spouses is from the US, it makes things even more complicated. So I would say always consult with the tax advisors because things could get really, really tricky when it comes to tax.
Then if your spouse is from US, then the question is on whose name do you invest? You can just choose to spend all your.
I honestly don't know, so therefore ask a competent tax advisor.
Good, I not found a good tax advisor yet. I had an income tax notice back there in India. But after coming here, I found out good tax advisors charge like $1,000 for 30-minute consultation.
They're not cheap.
You are in Dubai?
Not that, but it has somebody transferred me money and then they ask why did this person transfer you money. So basically, good tax advisors, difficult to find and very expensive. You would not realize why is this guy charging me $1,000 for 30 minutes, but yeah, that's what.
But I'll tell you what, I mean, it's about the value again, because, and I'm not trying to defend the tax guy here.
Do your research, you have to go to someone, pay that $1,000 and just get it vetted so that you don't get a surprise tax bill after 30 years.
Exactly. So would you rather pay $1,000 now, or I don't know, maybe $50,000 or even more sometime later?
But the
So
Indian tax is simple. It's not that complicated. Whatever earning in India, you have to pay tax. Even if you have money, you declare. If you're a taxpayer, with the return, you can bring all the money to here. Just you have to file one return.
So for Indian people, in Mint, there is a column which is coming just for NRIs. On Live Mint is a very popular financial newspaper in India. They are publishing a lot of stuff for Indian expats nowadays. So that is a place where you can start for taxes related knowledge.
I'm sure you can find a lot of free resources, but if you want to be 100% sure, try to find a competent tax advisor, which is not an easy thing, like you just said.
Correct.
But make sure not to end on the wrong side of the tax law, because that could be quite painful.
So it's 80-20 question. You know, what happens? You don't want to pay 100 to a good quality people. So we want to save that 20, and you get the wrong information, and then we spread like, you know, all doctors are not right. So you always said you pay 1,000, and because you get a right advice, and then you carry on, you say no, these are the right.
You definitely don't want to end up on the wrong side of the tax law.
How do we know who is a good tax advisor?
But that's what he said. Now he said this is how people.
That's a good thing.
I think it's more to do with the referrals. I mean, a group like yours can help us out. I mean, someone can recommend, and based on some recommendations, see, right now.
I get you, but I mean, if you ask me, do I know a good Indian tax advisor? I don't.
I agree with you.
I'm Lebanese. Do I know a good Lebanese tax advisor? Hell no. So
So the problem is we don't need an Indian tax advisor. We need an Indian tax advisor who specializes in people staying in UAE who are investing in the US markets, who IBKR.
Exactly.
You have to do your own research.
Very complicated. Yeah. There's no definition of good. It's very
Then become a tax advisor and you can have your passive income there.
On a question of diversification, so what would be your recommended diversification between growth stocks, growth funds, mid caps, and small caps?
I think we were kind of discussing this. I'm personally splitting between VWRA and small caps, but do I recommend this for all? The answer is no. Just keep it simple, because whether you're splitting between small, large, mid cap, and whatnot, you're just making a bet against the market. It might or might not work. So why bother? So I would rather keep it simple, stick with the world fund, because at the end of the day, even if small stocks would fly, will it really make that much of a difference? So keep it simple and just carry on with your life. That's my motto. Although, for full disclosure, I invest half of my stock allocation into small cap. So far, it hasn't been working well. Will it? Maybe, maybe not. But I'm taking a bet, and I'm well aware that I'm making a bet against the consensus, against the market. Will it work? Maybe, maybe not. If it doesn't, at least I'm well aware that it won't. So my advice is always keep it simple and stick to a global fund and let the market decide. Because the thing is, you know what? It's very psychological, because we want to have control, and it applies to me as well. You know, I'm not teaching is a big word. I'm sharing this all over the place, but I know that this is very emotional. And there is still a part of me that thinks that I might be able to beat the market if I go with smaller stocks or with mid cap or growth or whatnot. But none of that actually works. So just stick with the evidence, stick to a global stock, and you're good.
But what was your reason? Like, where did you read that? Did you just come up?
So basically, I invest. So I've not done IBKR or SARWA. I'm from the US, so I invest, through JP Morgan and
Oh,
all
okay.
that, right?
Okay.
So whenever I try and go and invest in any fund or any ETF, it tells me you are US. We are not allowed to, put your money in VWRA or IGLA. Or
Oh no, don't. As a U.S. citizen, you just.
No, but the JP Morgan and the Bank of America investment accounts that I maintain, which are connected to my normal checking account,
Okay.
they do not let me. So I will have to go and open a separate Bank of America Merrill Lynch brokerage account to be able to do global investments. So
But
that's where I was.
in your case, you could get VT as an American. You could get VT, which is the equivalent of VWRA. It has a fraction of the cost. I think it's 0.06 or 0.7 in terms of expense ratio.
Is the equivalent of VWRA?
It's even better than VWRA.
So I've been investing in VOO and VOG.
VOO is the S&P 500. These are 500 stocks.
Yes.
VT has close to 7,000 or 8,000 stocks, the biggest ETF I can think of.
VT, huh?
VT. I mean, I wish I could invest in VT, but I'm not American, so I cannot. So the next best thing is VWRA for non-Americans. But if you're American, by all means, instead in VT. And maybe for bonds, if I was American, I would go for either BND or BNDW. BND is the US aggregate bond market. BNDW is the world bond market. So these are the only two ETFs you need: BND, VT, or BNDW and VT, and you're done.
Yeah, but don't forget, like, US citizen and US person are effectively the same thing. Like, if you are traveling to the US a lot for business and you end up becoming a US person, that's like being a US citizen, by the way. A lot of people don't know that.
Yes.
So if you travel a lot, like for whatever reason, and there are some snare laws or whatever in the West Coast, where if you end up spending too much time in California, that's right. Even on vacation, you are effectively in the tax net, even though you don't know it. Like, but the IRS is like counting you in the tax net. So that's also a weird thing going on in the US. So people forget that, of course. I mean, unless you declare it and all the paperwork happens, you will slip out of it. But in your case, it's pretty simple. North Americans, Canadians, and US people should not at all touch any Irish stuff at all. It's been like flagged on the Brokerage forum everywhere. It's a bad idea. It's actually worse. It's actually detrimental. So just avoid that in any cost. That's why it's stopping you from doing that.
But I think for US citizens, investing in something such as VWRA, you get exposed to double the tax. So therefore, Americans are better. I mean, you'd be much better to stick with US funds such as the VT and BNDW and whatnot. Yes, please. I'll answer that. Are you planning to retire in Canada?
Debatable.
Debatable. Okay. I'm sure you've heard about Andrew Hallam.
Yeah.
Andrew Hallam is Canadian.
Yeah.
So I read one of his articles one time during COVID. He was traveling in Canada and then he got stuck because of COVID and whatnot. And because he spent more than X number of days, he became a Canadian tax resident. Luckily for him, he was investing in Canadian listed ETFs, so he was good. But let's say, in your case, if you're investing in V3AA, which is a great fund, by the way, it's an ESG fund, right? So congratulations on this one. So if you get stuck in Canada for whatever reason, if you're flying there and you get stuck, and for whatever reason you become a Canadian tax resident, you might end up on the wrong side of the tax law if you're holding V3, and anything which is not Canadian, basically. But if you're not gonna retire in Canada, you don't travel there, you should be okay. Again, in theory, I'm not a tax expert, but I'm just saying.
There for like 3 weeks or so every year.
I'm not, maybe 3 weeks, maybe a month. I don't know the details.
That's
but
your residence.
actually, as a Canadian, you could choose. I don't know I think VGRO or something like that. I don't know the ticker symbol from the top of my head. But there's a couple of ETFs Canadian listed ETFs that you could invest in, and they're safe. I mean, even if you retire somewhere else, it's not the end of the world, but they're in Canadian dollars. Sorry, it's a global fund, because when I say they're in Canadian, they are denominated in Canadian dollars, but that doesn't mean that the fund is actually in Canadian dollars, because the thing is, it might look as if your money is in Canadian dollars, but it's not, because it's probably 50% in US dollars, another 30% in euros. It's basically, it follows the world split of global stocks. So although it appears to be in Canadian dollars, just like the case for VWRA, we're not investing in US dollars. What if the US dollar tanks? I don't care, because my money is spread across. First off, I own assets and not, it's not a currency. It's not like I have US dollars in the bank. If the dollar loses its value, and I think Muzammil here can talk a lot about this. So I don't own a currency, I own assets, and these assets are basically global assets. I have US stocks, I have Canadian stocks, I have European stocks, Middle Eastern stocks. Whether you guys know it or not, in VWRA, there's a lot of companies that are publicly listed here in the UAE and in Saudi Arabia and other parts of the Middle East. They're part of VWRA as well. So your money or your pot is pretty much diversified globally. And that's why I prefer a global fund as opposed to an S&P 500 fund.
Life is easier as Canadians as well, because they're effectively US type. So you guys can even go with the US, directly with the US funds, and it's safer because you have a tax treaty between. So,
but if you live there, I think if you live outside of Canada,
again, tricky. I mean, she has a passport, so again, how it's treated in the end. She's here. She can even do.
If she's not tax resident, that will not help.
Yeah. So that's what it is. Like on the Bogleheads forum, there's a table there on the website, on the wiki, which says, okay, yes, it's safe for Canadians and US to basically invest, in Canada or the US, vice versa. So,
but the thing is, if you guys are a UAE tax resident, even if you're from Canada or UK or what, it doesn't matter. It's where what matters is your actual tax residency. From a legal perspective, at least.
Nationality is not relevant.
For a couple of countries, it's different, because I mean, the U.S. tax law applies whether you are in the U.S. or outside the U.S. Sorry, I mean, hard luck for you guys, but it is what it is, I guess.
Tell me about it, yeah. It's a bad one. Based on your knowledge, so I've been throughout my life a big believer in real estate.
Okay.
I've been written many times, and I'm slowly and gradually trying to diversify now. So what's, based on your research and your knowledge, what would your recommendation?
Research is a big word, man. I'm not a researcher. By the way, I'm just an IT guy, man. I'm not into finance. I never studied. I've never studied finance or anything like that. It's just like I started learning about personal finance, and I ended up reading a bunch of books. But that doesn't make me an expert by any means. So, like I said earlier, I mean, to me at least, that's a personal thing, not based on research, not based on anything. There are three major sources of passive income. One being real estate, which is the oldest thing. Another one being the financial markets. And when I say financial markets, it's not necessarily just the stock market. It could be crypto. It could be just anything that is traded on the financial markets. And the third option is to have a business. It could be like, a pizza place that you own and that you manage, but you don't work yourself in the pizza place. That is considered as passive income. So in an ideal world, if you could diversify across these three major passive income streams, if you will, you're good. So don't keep all your eggs in a basket. Diversify across financial markets, real estate. If you're into this, I'm personally not into real estate. Nothing against real estate, but I'm personally not into this. And then again, the business. So if you can have all three, kudos.
Since you're talking about real estate, I want to touch the Bitcoin matter. I'm not doing it. I'm still like
Bitcoin?
Yeah.
There you go.
I think you've heard that SARWA might be switching their current BTEC something Bitcoin ETF, the old one, into a new one with a much lower fees.
I don't know.
Well, you don't need to. I mean, I don't know why people want to buy the ETF. That's for the US crowd. If they want to have like a tax account situation, it only makes sense in a taxable account. But if you want to buy Bitcoin, just buy Bitcoin. Why do you want to do the why do you have to pay someone to hold it for you? And then, like I said, if you have a Roth or something like the US guys, the Canadian guys, they want to put it in their tax advantage account, then it makes sense.
But isn't it similar to the ETF? SARWA has one of the ETFs that's related to the real estate, right? I don't want to invest in real estate.
That's called a REIT, REIT.
You're talking about exposure. You're talking about exposure. So exposure.
Maybe I don't care about the Bitcoin. I just care about the
price exposure.
gains
Yes.
that might be good to me.
All right. Yes. So then, in that case, you don't want to hold it. So you can buy the cheapest. You can keep it under $60,000. Buy the US ones. Whatever state taxing, because there's a European ETP there. You can buy that one as well directly if it's accessible. I don't know how much SARWA is charging for that. From that price exposure point of view, yes, that's okay. But again, the fees, right? You have to look at the fees.
Currently, they have something BTEC something. I don't know. It's 0. It's 2%. It's much
no, that's very expensive. Yeah.
The expense ratio?
Yeah.
That's ridiculous. That's ridiculously high.
But they're gonna be switching very soon, as per one of the co-founders, to a Vanguard related, not Vanguard.
Vanguard?
Well,
I
say
doubt.
if you keep it under $60,000 in the US account. EasyBC ticker is like the lowest cost ETF. It's by 0.19 per year percent. Yeah, it's very low. It's the lowest cost because there was a fee war just before the launch, and then after that you have your IBIT from BlackRock and all of that.
It's always going to be they're gonna all try to negotiate and lower their expense ratio. I mean, it happens all the time.
The reason is that they didn't, like, for example, GBTC, which already had like 600,000 Bitcoin in their fund, they didn't go down. It's because people are stuck in it, and when you take out your money from it, you get a big capital gains tax on it. So like, okay, I'm going to stick with it. Why should I want to? But still, there was a long reason. There was a long period of outflows happening because people don't care, some of them. And again, with ETFs, you don't understand, like, it's nothing for us, but what matters in our case is the volumes. They matter a lot for them because they're coming in with $100 million orders, and if you don't have liquidity to buy that much, like, it doesn't matter for them. Like, hey, do you have that much Bitcoin? So that's why BlackRock and the big ones are moving around like all this money, because okay, we are looking at the expense ratios because our outlook is different, but they want, do you even have this much to you want to buy this much from one order? Like, that's how it works on the other side of the market, the Wall Street, how they buy. There's a different reality. Of course, when you see, hey, why is there so low volume in my low fee ETF? That's the reason, because it's about volume versus the fee. They don't care that much about the fee. They want volume. So it's a different game completely.
By the way, Muzammil is a huge advocate of managing your own ledger when it comes to Bitcoin. And by the way, for full disclosure, obviously, like you might have noticed, Muzammil is a huge fan of Bitcoin. I'm not, but for full disclosure, I bought a fraction of a Bitcoin a couple of years ago, and a couple of other coins, including Ethereum. Not a huge believer. I bought some. If it goes to the moon, I'm not gonna complain. If it goes to zero, I wouldn't care less. So I just bought and kept them, and I'm not touching them anymore.
Do you think 5% is reasonable to allocate 5% of your portfolio towards Bitcoin?
Is the question to me or to Muzammil?
To you. Because
I'm personally, I mean, the amount I personally invested in Bitcoin or in crypto is probably less than 0.5% of my total net worth. Yeah, so anything above that, I mean, it's not even percentage.
I wanted to know, because I'm not a big believer in Bitcoin, not like him. This is why I want to see how you would think about it, since you're not believing in it.
So the question is not about Bitcoin. The question is about risk capacity versus risk profile. It's not about Bitcoin at all. Like, I know people who invested in VWRA and put like $200,000 in it, like, and they were panicking because their portfolio went down by $100. It's like,
yeah, it's true. It's true. It's very true.
Yeah. And there was another guy who put in like whatever amount, and his portfolio dropped by 10% in Bitcoin. He's like, yeah, I'm fine with it. So
yeah, the question is for you now. For let's say your whole portfolio, if you can answer that, right? How much are you allocating a percentage towards Bitcoin?
Me again? Muzammil. Okay.
Yeah. See,
100%. Close to 100%, maybe.
The reason is that I didn't come to this thing because of greed or something. I try to help people from Pakistan and other my family members. They can't access all of these things. There are capital controls, there are wire fees that are expensive, and frankly, they can't wire across the world anyway. So what do you tell them? Okay, go for property, what, down payment, and then interest rates and all of that? Like, no, not everyone can do what we're doing here. This is the bubble, by the way. It's a very small bubble, and it's a Western global economy thing happening. Half of the world cannot access these funds. So the people who cannot access them, what do you tell them? Like, well, okay, go to the UAE, open an offshore account, maintain the balance here, wire the money here. Like, come on, right? You can't tell that to people who are regular teachers and doing small jobs, whatnot. So how do they protect their savings? They can't do anything. What choice do they have? So, okay, yeah, leave them behind, do whatever you want. So I told them no. The answer came to me. I just stopped saying everything. Don't stop jumping through hoops. Just buy 6 months of USDT because the hyperinflation going on in the PKR and the rest go in Bitcoin. My family members are up like what, about 200% since last 2 years. They're fine. Their savings are protected. They're keeping it offline. What's wrong with that? It's outperforming everything. What do I say to them? What, go open a bank account right
now? I mean, 5 years down the line, 2 years down the line, it could go to a very different level altogether.
Yeah.
They lose their little bit of savings that they have right now.
Why would Wall Street launch 11 ETFs, and the most successful ETF launch ever, by the way, beating gold inflows, beating S&P 500? Is BlackRock suddenly they've lost their mind? That's the question, right? 11 ETFs launched, and the most successful launch happened regarding inflows. So this is what they don't understand. It's nothing about greed here. It's about access to capital, investing in something. They can't access property, by the way. So what do you say to these people?
So according to your logic, the main reason crypto is for people who don't have access to the other way of investment.
Yeah.
For that sake, you strongly believe that for them, this is one of the best
Well,
investments.
you have a choice. Tell me what's the other choice.
No, I don't. I'm trying to understand.
There is no other choice.
I didn't think from this perspective.
There are capital controls wiring out of, even in Saudi, by the way. If you want to wire out to Interactive Brokers, they put in capital controls where you cannot wire across to accounts which are not in your own name. And you must have seen the post on SimplyFI as well. Like, okay, how do I wire? The bank is not letting me wire. So I was working on a risk document for this stage. Like, okay, understand the risks. There are risks here as well. Like, nothing to do with you being something illegal. You change your jurisdiction and you can't send your money across. So these are all realistic evidences I'm giving. I'm not advocating for Bitcoin. I'm saying this is the risk working in this environment. And I mean, I was sent like a 9 question after being with HSBC for like 17, 18 years. Like, 9, why did you send these wires to these people? Like, it was income coming in from different consultancies at it. So your money is not your money, right? And I have like 4 different bank accounts, so I don't care. I can go wherever I want. But what about the poor other guys? Like, what do they do?
And when it comes to the platform, in your case, you suggest Binance, or I know you're.
No, Binance is P2P. Binance is P2P. Yes, Binance has become the strongest because of the US regulatory pressure, and they have effectively become the most strongest now at this point because now they have been vetted. SEC has left them alone after finding them because they couldn't touch them. Apart from that, yeah, there are like really good ones now. Bitstamp is good. European domicile. There are some Swiss players that are really good. So I mean, the space is now different. The local ones are charging too much. CoinVina and all that, they're charging too much. Like this, because effectively they're just middlemen. So if you understand, like if you're willing to wire to IBKR or whatever, you can wire to these guys as well. It's not different. And I used to send them when they were like, there was no regulation, and it's been fine since then. Full disclosure, I missed the FTX collapse by 5 months.
Oh.
Yeah. So if I would have left it there, I would have lost a lot big time. So FTX collapse, I missed it by 5 months. So I was looking at the last withdrawal I made, and then the collapse had happened. And yeah, see, leaving your stuff on the exchanges is asking for trouble. So
yeah, going back to the 5%, and maybe I answered you from my perspective, but in general, if you want to keep 5% of your total investments in something very risky, it might be Bitcoin or something else. It's not or maybe some individual stocks. That's perfectly fine, as long as you limit that to 5%. Because I mean, even those who follow the bogleheads or the passive investment methodology, I mean, I'm a little bit extreme, so forget about me for now for a second. I'm a little bit extreme. I don't do this. But for those who would like to venture into something, let's say a little bit on the risky side, or they want to bet on a single stock, and if you want to keep this, as long as you keep it to 5%, because even if you lose that 5%, you still have the 95% to back you up. But don't get into the, because there's something risky in this, because if you go, you know what, I'm gonna take 5% of my investments and put that all in Nvidia, now I mean, a single stock, or Microsoft, or whatever the case might be, because you know what, Nvidia went like 300% over the last 6 months. Fine, as long as you limit that to 5%, because the trick here and the danger is, if Nvidia kind of tripled, you'd say, maybe I would go to 10%. What if I go to 15%? And then you go into that rabbit hole. So if you can stick to 5%, and if Nvidia did great, then that 5% became 10, then you sell some of your Nvidia, and you basically treat this 5% just like any other asset, and you rebalance. You just keep it at 5%. If it goes above 5%, you sell some of it and you reinject the proceeds in your core portfolio. If you do that, no issues at all.
I mean, these are all mindset questions. Honestly speaking, they have nothing to do with the asset. I just use the term pain is a good motivator sometimes. Like, so
pain is good
motivator.
Good one.
And you just you pay attention more. If it's your portfolio or your real life, whatever, it's always the case. Like, okay, this is causing me pain. It's not worth it. I need to re-examine. Is it like a realistic? Is it like a more emotional response? Is it a realistic thing going on? So I mean, that's about it basically. And like I said, that I've seen people freak out over. I mean, nothing. This IBKR question has been coming up recently. Like, okay, what's going to happen? It was the first question we get always. Like, what's going to happen to the broker? Anything can happen to anything, by the way.
Exactly.
It's a fiat world we live in. So that's it. Anything can happen to anything. Yes, okay, you want to be absolutely safe, you can go with the big banks and keep your money there, and some government will come and bail them out. That's fine. But like even then, there'll be a haircut involved. For example, if a brokerage collapses, there's a long drawn out process, take maybe 2 years, maybe, who knows, and you will get money at the end of the whatever price they would have agreed to. It would not be the current market rate of your invested assets. So this is what people think, that okay, it's going to be a straightforward thing. And same thing happened with FTX. The people who had invested, they're getting their payouts, the bankruptcy thing, because I had like $4 left on it. So I'm seeing the tracking happening in front of me. I'm getting paperwork from the lawyers and all that. I don't need to, but still, it's like showing, okay, yes, they are settled on a payout to be at the $16,000 Bitcoin price, which is $60,000 at the moment. Imagine the haircut they're getting. So something like that. I read that the bankruptcy, that's how it works, even if it stops. So the risk is there, yes. Account risk is there, wire risk is there, all kinds of risks are there. And then the best you can do is understand them and just be, just accept them as they are, as the world it is. Like, there's a risk crossing the road always. And I suffered in property. I had like lost half of my money in property. I got rid of it, and I couldn't handle it. Like, I didn't want to deal with the brokers. I didn't want to deal with the government. I didn't want to deal with anyone.
On that note, question about real estate. Considering you're so high, is it a good idea to buy or rent, especially in this market? Leaving the emotional aspect of it.
Let me share
completely out of the mix.
Let me share this one thing. My wife is a big believer of real estate, right? And I'm not, honestly. So I've done some calculations only a couple of days ago. It's a special case. It might not be the case everywhere else in Dubai, right? But I live in Marina in a certain tower. I was checking on a website, DXB Interact, and I found that my apartment was sold for 850,000 AED in 2012. Currently, the market price for the same apartment is 1.2 million. I've done some maths. I've checked the taxes, everything that the owner had to pay since 2012 up until now, right? And it was around 1,100,000, I guess. I considered the mortgage account, the interest, right? And then I even added a rental average per year, right? The owner is going to be renting the apartment. If the owner is going to be selling the apartment today for 1,200,000, it will be a loss of 80,000 AED. So when I looked at that and I saw that an investment touching 1 million AED for over 12 years, that's minus 80,000. This was like a proof to me that real estate is not a thing. It could work somewhere else. It has its own tricks. You have to really be diving in it. But personally, this was like a big hint for me that real estate might not really be a good thing.
Or you could,
as difficult as anything.
or you could buy in during COVID. That would have saved you.
Exactly.
You should be timing it. Otherwise,
buy apartments that the owner really want to sell it for a lower price. It has its tricks.
yes,
If you just want to go with the flow, get a mortgage,
it
buy
will
an apartment.
exactly.
It's not a good
During COVID, any investment was good.
Yeah.
And you have to remember the headache this owner had for 12 years since 2012. Paying taxes, talking to agents, finding tenants, the whole headache she had to do the maintenance, do the apartments, etc., etc. Or else if you go with the regular ETF and index funds, then
I actually sort of disagree with that because I've done a couple of flips myself and I've actually made some money, but now I'm not too sure if the market that we currently live in is something that we should be going in with, like buying. So that's why I wanted to
No,
hear.
if you're doing active investments and selling, exactly, buying and selling, it will make you money. Like, but you cannot do like passively.
Yeah.
The thing is passive.
Like for you to live in it, would you buy or rent, considering the market that you have today, and you have no emotional attachment to I want to live in my own house? So then.
Okay, I can answer that, but this is entirely from my own perspective. But that, I mean, that doesn't mean anything. That's just me, right? So I'm more than happy to rent until the end of times. I'm serious, and I would maybe I would I think I did share this before on the group. There's an awesome video by Ramit Sethi. He's one of the I would say personal finance gurus. This guy is he's on Netflix, right? So this guy is a multi-millionaire, and he rents. He's renting. He said like he might buy at some point, but like again, sometimes it makes sense to buy, but buying just for the sake, because we were all brought up, and myself included, with that script. You need to buy a home, you need to buy a house, you need to buy, and disclosure, I bought a house, I mean, back home, and I still own it, right? And it's sitting collecting dust. I'm not even living there anymore, but it's still collecting dust. Was that a smart financial decision? The answer is no. It is an emotional decision, maybe. So for some, if you can buy and if you can make money out of it, great. It could be a good investment. It's, again, I'm not into real estate, but I'm not against it. But I would always say, just like Ramit says all the time, run the math before you before you make the decision, because many people would simply jump on it because it's the script and it's the we've been programmed this way.
But there is another thing. If
the lady had a question for a while.
Yeah, my question is, what are the pros and cons of expat, like a platform like HSBC Expat or any bank platform?
Sorry,
brokerage platform, like HSBC Invest Direct or any other platform only.
They're expensive.
I personally use banks for banking and a broker for investing. I don't like to mix the two because banks are never good for investment because their fees are normally ridiculously high. That's the ugly truth.
Safety versus fee, whether they'll be safer than IBKR or
safety, I don't know, is HSBC safer than IBKR or is it the other way around? It's anyone's guess.
I would say they are. I mean, as much as I don't like them, but they are. The reason they are is that because they are too big to fail, and all the major governments will, and that's why the rich use them. By the rich, I mean you're making an allocation of, hey, I wanna, my average trade size is $50 million, so like they don't care their fees. For them the small percentage is they're fine. They're already rich. I mean, we're talking about ultra high net worth, right? There was a time they called emerging affluent, which is and someone with $200,000. Again, these are all marketing terms, but like I said, that for that size, if you're talking about fees, like there's a joke that, okay, if you have to ask the price, you can't afford it, kind of thing, right? So for them, they can afford it, and they're there because they don't want to move around their assets. They don't want to do the fee thing too much, and they're fine with it. Again, like I said, that if you're on that level, you wouldn't be here.
So what was the term you used? The ultra affluent?
Yeah, ultra high net worth.
Yeah, that's another word for filthy rich.
Which is about $35 million. I don't know if it's liquid or invested out. So something.
Yes, sure.
Are you invested in the Dubai financial markets? Any IPOs that you're looking at or you had experience in?
I'm personally not into any IPOs whatsoever in any corner of the world. And I'll tell you why. If there's an IPO, let's say, I don't know, DIWA, whatever that is, if it becomes a public company, I will automatically and indirectly own it through the index. So that's why I don't personally invest in any IPOs or any individual companies. But again, that's just me. And by the way, statistically speaking, 95% or even more of the IPOs do not make money. And I think I posted something about that a while ago. IPOs in 95% of the cases, I mean, there are the numbers. You can check the numbers. IPOs don't make money in like 95 or to 98% of the cases.
There is another thing. If the IPO is coming, if it's a really good company, it will be oversubscribed, and you will not be able to get that much of shares in any case. So there is no point worrying about 5,000 dirhams or 10,000 dirhams. The second thing is that just take an example of Salik when it came. It got a huge boost at that time, but then after that, if somebody has sold it, they would have been making the loss, because right now Salik has gone to the moon. So it depends. I don't actually also invest in IPO because it doesn't make sense for me to invest so much of time thinking about it.
The thing is, you could get lucky. Don't get me wrong. Yeah. You could get lucky once, but do I jump? Does that mean that you need to jump on every single IPO, even if the company is good? By the way, there's a false misconception that we all, and I used to fall for this trap myself. Good companies doesn't. I mean, a good company doesn't necessarily mean it's a good investment. And again, I think I shared a video by Ben Felix about that proves that good companies are not necessarily good investments. Actually, it's the other way around. It's usually the company that you've never heard of that is typically the best investment. It's very controversial. It's counterintuitive, but it's true. I mean, quite honestly, if you drive on Sheikh Zayed Road, you'll see like tons of these ads. Most of these platforms focus on CFDs and Forex. And I would not touch these with a 10-foot pole. Anything that focuses on CFDs and Forex, I wouldn't personally touch it. Now, are there local platforms that are good? I know about SARWA. I think they're good enough. I don't use them for full disclosure, but I think they're good. Other platforms that focus on, they show you like people trading and whatnot. CFDs, anything that focuses on CFDs, and they call them indices, CFDs, and whatnot. And,
yeah, because they are not actual shares.
They're not actual shares. You're buying like these are like
the numbers. You're buying
you're buying the numbers. You're just placing bets.
CFDs are like not, you can't sell CFDs in the US market.
I didn't know that.
So there are only 4 platforms so far as I know in the UAE: Standard Chartered Brokerage, Citibank Brokerage, HSBC Brokerage, and SARWA. These are the only like real platforms which do real US market, international market. I had a Citibank Brokerage early on, and when I couldn't find, like I was looking for some ESG ticker, Sharia ticker on there, and they didn't have it. I just emailed them and they added it. So that was my experience with Citibank, but was expensive, and they are the only ones still charging a custody fee from all the other bank brokerages. So these are the only 4 platforms I know which are the real platforms. Right? The other ones are mostly CFD providers, and that's why they can onboard you within minutes and like can start doing whatever.
It's CFD is like it's the casino basically.
CFD means contract for difference.
I'm sorry.
Swissquote
is a good one. I mean, it's part of the, actually Swissquote is actually there are 2 Swissquotes. There's one in Luxembourg and there's one in Switzerland. So these are international brokers. I would say these are among the top 4 that we usually recommend: Interactive Brokers, Swissquote, Luxembourg, Swissquote, Switzerland, and the 4th one is Saxo Bank. Now, again, there's no perfect broker. Each one has its own pros and cons. So to each their own. That's what I usually say.
You can buy it through VO also. No? Nowadays, VO also giving option to buy
VO. Yeah. So the VO might have tied up with some US based. What they do is they tie up with a securities provider in the US and they partner with that, because getting a securities license in the US is much more difficult. So that's how they work effectively. So they probably have some kind of profit sharing, agreement with them, and that's why we say go to the source. The source is Interactive Brokers. Go to the source brokers which are based there. If you go through anyone here, they will of course have to have a cut because there's a local operational cost involved, and that's the end of it. So, and the banks of course have a lot of overheads with anything they do, the AML, CF, whatever they want to do. So like basically bothering us all the time. So
that's a very good point. You mentioned something about budgeting. This is something Wali mentioned earlier. Some people budget, some others don't. I do budget. I do track my expenses. But let me tell you something. None of that is important. What is more important is to pay yourself first. And I say it all the time. just take whatever. I mean, as soon as you get your money, I mean, you're salarized, right? As soon as you get your money, if you have this habit, or you know what, forget about habit, because habits usually don't work. Automate things. What I normally do, as soon as I work in IT, and I get my salary at the end of each month. On the first of each month, I have an automatic standing instruction with my bank. It takes a certain amount of my salary, and it's gone into another account. I don't see it anymore. It's automatic. I don't have to think. I don't have to trigger anything. I just set it up once. It's like set it and forget it. So I take X amount of dirhams, and it's gone into my other account. I'll get to that in a second. Then part of that goes into my interactive broker or Swiss quote account. Then I have another part that goes into my, because I pay rent on a month, I have 4 checks, so once every quarter. But instead of waiting for the check to be to you know, exactly. So what I do is I take 1/12, so basically what the monthly rent, and I move it to another account, and that also happens automatically. I don't have to do anything manually. I think I've written a long post about this, and this is what makes my life much easier. So 1/12 of my annual rent goes into that account, and then I have my checking, which is linked to that account. By the time the landlord basically claims his check, the money is already there. I don't have to worry about it. I do the same for my annual travel or vacation. I have like a special, I call it my fun fund. I save every month a certain amount. That is because I usually know what I normally spend when I travel, and traveling is something which is very important to my wife and myself. So this is something we do on a yearly basis, and this is our guilty pleasure, so to speak. So I save on a monthly basis the amount I need, on my annual travel, and by the time I need it, it's already there. So the thing is, and the rest I take care, and I spend the rest basically guilt-free. Then I have my, my utilities bills, my other stuff. Everything is handled, and I have my basic stuff, automated as soon as my money comes in. So pay yourself first. By that I mean put some money aside, either for investing or for saving for some big ticket items, and you're good to go. So this is one of the most, I think this is one of the most useful tricks that I usually do. And you need the budget to understand roughly what you spend. It's all about automation, because you know that what we normally think is that, you know what, I'm gonna use my willpower, and this month I'm not gonna go to that many branches. It might work, it might not work. But the thing is, if everything falls into place, you don't have to worry about any of this. That's the thing, because there's a book that is, by the title, the title of the book is Willpower Doesn't Work. It's very true, because our willpower is very limited. I'm not gonna eat that cake. I'm not gonna eat that cake. I'm not gonna eat any cake. Then at the end of the day, you eat like 3 cakes, because your willpower, there's a limit to what your willpower, what you can do with your willpower. So therefore, plan your meals. For those on diet and whatnot, if you plan your meals, you're more likely to stick to the plan. But if you just don't say, okay, you know what, I'm gonna look at the cake, but I'm not gonna eat it, it won't work.
About savings, yeah. Let's talk a bit about the short-term savings, like 1 year to 5 years, for other matters, not investment, right? So you're gonna be saving in a certain account towards those goals, and you want to save it somewhere that could actually give you some income, some interest, right? This is why because of this group, I trusted
we, yeah.
Exactly.
I'm not with them, by the way, but
so I've moved my emergency fund to that bank, and I'm loving it because I'm earning 5%.
Which bank? Vio Bank.
But yet again, I'm gonna be starting saving for some other short-term or mid-term, right? I feel like I might not be safe to put in the same bank, right? I want to ask this review. So, is there any other option besides Vio that you could?
I do national bonds. I do national bonds.
Which one again?
National bonds.
National.
They are also good. Like not like 5%, they are giving around 4.5%.
But they say there is a.
No, I get 4.5% with 100 fees.
No, there is a new scheme in the national bond where you get almost 6%.
Almost 6%?
There is something called IBOR bonds. Minimum investment is 25,000.
Okay.
Minimum. It used to be earlier. It used to be 25. Then they went up to 500,000. Now they came back 25,000 minimum. You have to commit 3 months. It is on 3 months IBOR rate. So currently,
So it's fluctuating as well.
Every day it fluctuates, but it's 5.3 plus 0.5%.
Okay.
Per annum.
No, it's national bond.
National bond.
It's not a bank. It's
Yeah,
bonds,
I would personally.
based in the UAE. No, you can get it from Al Ansari.
I would personally stay away from anything that requires a minimum and that locks you in for a certain period. To me, these are red flags.
Withdrawal is very
Somewhere around
4.5%, yes. But you can withdraw it
I know,
without any penalty.
but
very
basically
small
anything that
profit
has a
penalty.
minimum amount to get in has some catch somewhere. Believe me, there's a catch somewhere. So basically, WIU is a good option. Another option could be Live Bank. I'm not sure now. Lately, I think they're like 4% or. No, okay. So the VWRA is not applicable, but the concept is. So basically, VWRA is just a world fund. It happens to be suitable for Europeans and most non-Americans. But for Canadians, there's a set of similar ETFs. Again, I don't know the tickers from the top of my head, but I can share those with you. I mean, if you just shoot me a message or something. So in short, he could simply buy a global fund domiciled in Canada, traded on the Canadian Stock Exchange. And if in 7 years he moves out of Canada, he can always move his portfolio with him.
IBKR in Canada.
Actually, in Canada, he can open different kind of accounts. Again, I'm not into the Canadian investment platforms, but I can find this for you. He can open something which is much cheaper and much better than IBKR for those who are living in Canada. Or he could still open an account with IBKR, and then he can move his account whenever he moves outside of Canada.
There is IBKR in Canada because my friend migrated 2 years ago, and you could get a Canadian domicile IBKR that's there. And also the cash there is the TFSA, I think you call it, whatever, the tax advantage account. So make sure you do the allocation for that first. You keep that topped up.
Exactly, the tax advantage.
Rest goes in the non-tax advantage, which is the same advice for any
American,
any even European, I think, right? They have their tax advantage.
Exactly.
So that you top up that fund first, and the rest goes into. So I'm not sure if IBKR automatically does that because I don't have visibility on the portal for it. So simple, yeah. And the account opening is free. There's no cost to it, so why no harm trying it? I forget there was another one, Invest Direct. I think so. That's what I'm forgetting that. Maybe that's
yeah. Canadian platform.
Isn't Andrew Hallam's nationality? You might have already written about it in the group.
I think so. I think
If
so.
If you look for posts from Andrew Hallam, because I think Andrew Hallam himself is Canadian, so I think he might, whenever like questions on Canada comes up, because he's the Canada expert among many other countries, I think he's already written about the Canadian kind of best option.
This is James, by the way. I don't know.
Sorry, I'm so late. I was out cycling for a long time, so I just got here, and trying to find parking is very difficult. The beach is very popular.
On your bicycle?
No, I drive. It would have been faster to ride across here. But,
exactly.
Yeah.
Also recommends the money market.
Yes, money markets. Okay, so let me explain money market. A money market fund is just like a bond fund, but with an extremely short term. It's like maybe less than a year. So think of the money market as a very short bond fund. That's what it is.
3 months, huh? 3 months?
Something like that. Yeah, usually less than a year.
What is the rationale for him like recommending to use this?
It's basically he uses that as a way. I mean, instead of a high interest account, he uses a money market fund, or in some cases a very short term ETF, bond ETF, which is more or less the same thing.
money from you and lend it to some companies. And
Exactly. Plus, it's very, very low risk. I mean, there's no such thing as zero risk, but it's very, very, very low risk. So it's almost as if you're lending your money to a bank, basically.
And they're available on IB, and you can like find them and
Correct.
them on
Yes, yes, correct.
It goes over my head every time. So when do we get tax, or when do we pay tax? Is it when you're withdrawing, or how is this thing going?
As a UAE resident,
yeah, you're a resident from India.
you don't pay any tax. End of story. Except
dividends.
Except the tax you pay on dividends, because even as a UAE resident, you still pay tax on dividends, except that if you buy the funds that are domiciled in Ireland, they pay those taxes internally, so you don't get to see them. But you're paying those taxes whether you see it or not. So, but you don't have to worry about paying any tax. Now, if you move back to, are you from India? Now, if you move back to India and if you sell, I believe there's a capital gain tax. Then again, it depends on the country you're from, because each country taxes differently.
That time when I'm withdrawing from here, or that's when
No, if you're still a UAE tax resident, if you're a UAE tax resident and you sell, you pay zero taxes. You get the full amount, no taxes whatsoever. Yes.
So I'm at the other end of the scale.
I'm sorry?
at the other end of the scale, close to retirement. So I have V60A, which I'm going to have to sell before I move back to Europe. Then what do I invest in? Do I go VWRA and make my own analysis, or do I?
I'm sorry. Is your question about what to do when you're approaching your retirement?
One is it V? Should I go with V60A or do my own spread, and then the second question is, I'm moving back to Europe, so I have to sell in order not to get the capital gains. Before I leave, I have to buy something else. Do I buy that again, or do I buy a bond fund and an equities fund?
That's a good question. So depending on the country you're retiring in, because each country has different tax laws, but in most cases, you might want to sell while you're a UAE tax resident, so that you can reset the clock, so to speak, on the counter on the capital gains. And once you repatriate back home, you could reinvest in the exact same thing. Nothing wrong. Again, it depends. If you're British, you might want to invest directly with Vanguard. If you go, I'm sorry. French, Française. Okay. In French, you could reinvest in the V60A or the V80A, which is it's a fund. It's a single ETF that has both. That's the simplest thing to maintain. So basically, once back in France, you can still reinvest in the same ETF. But the thing is, I have zero knowledge about the tax laws.
I've done the tax investigation. The question is that should I be in one fund, or should I split between VWRA and a bond fund?
It doesn't matter.
Should I go back into the same?
It doesn't matter. I mean, to me, keep it simple. I mean, as a French citizen, and if you want your money in euros anyway, so why managing two funds and rebalancing each year? Buy a single fund. Keep it simple. So all of your money would be. I mean, if I am close to retirement, I would personally put everything. If I was European, I would put everything in V60A. Or the V60D, I think the distributing part. It doesn't really matter. So basically, either one or the other, and that's it. You just sell enough per year so that to cover your expenses. That's it.
And then the third question related to the property thing. I've been looking at buying a studio so that I can come back here 6 months of the year and stay out of the French tax.
Yeah, that
rent
might.
It out the other 6.
That might work, but again, you have to.
But I'm saying, in terms of property, with your calculations, does that seem like a viable thing to do? It's putting a smaller amount and buying a bigger property, and then still having Boltol as being able to stay there.
Are you going to rely on that income?
No.
Then it's fine, because I know a couple of people, like including me and everyone I know, who has like the tenant didn't pay for 1 year, 6 months, and I'm talking about even Silicon Oasis where I live now. Downtown property, Omnia at the pad. I'm not talking about like some backwater places, right? So tenants are unreliable. Anything can happen. Life happens. Person just stopped responding. One person just left, and he said, "I left the country. Do whatever you want." So anything can happen.
Yeah.
So
I'm thinking of it's a studio on the Palm, which is a good location, full disclosure. And I'm thinking of staying there 6 months and then Airbnb the rest.
that then think of it as a consumption asset. Don't think of it as an investment asset. Like
Exactly. It's like your home. You're not renting it out, right? So
I mean, let it. I mean, like I said, a dusty apartment is better than stuck in litigation, which it took my uncle 6 months, and he's retired, by the way. He couldn't have access to his own asset for 6 months. What kind of asset is that if you can't even like have access to your own asset? So that was my frustration as well when I suffered through all this. Like, is it really my asset? I don't own this. So it took me like 3 months of litigation, and then the UAE court said, oh, the guy said, oh, you were messaging me on the wrong number. Please give me another chance. They gave him another 3 months, by the way. So it ended up being 6 months, and then finally the police came in and they broke down the door and all of that. Like, so if you're gonna live in it, just live in it. Just
but it will only be for half a year.
let it stay dark for half a year. It's safer.
Okay. Thank you.
Maybe just run the numbers on it, because one other thing as well is like if you're, as you said, you'll live in it for half the year, maybe the other half of the year you'll Airbnb it. But which half of the year is that? Presumably you're not going to be the 6 months in the summer.
of course not.
Really like it hot. It's like
Yeah.
so if you're thinking, oh, I'm going to be here in the winter and then it's empty in the summer, what rates can you get in this summer? I know they've tried to make summer surprises and build that as a tourist time, but you know that's the low season. So
I can take my 6 months.
yeah. That's one thing, and also one other thing maybe to look into is like long-term stays in hotels, because you may find actually by the time you put together all the costs of buying the studio, paying for DIY, housing costs, blah 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 blah, telecoms, internet, all that stuff. If you are going to Airbnb, you may actually say, oh, hotels actually will give you a 4 or 6 month good deal, and then you can stay on the Palm or stay in different places in Dubai. It's worth kind of looking into, because sometimes they do give good deals. So
it's that whole thing about having also come from a culture where
yeah,
you have to have
yeah, of
something.
course.
yeah, that's the usual script.
Yeah, and it's ingrained.
Yeah. I know.
I don't blame the people. I mean, like she said, like the fears are real when people's bank accounts are closed in Romania and Pakistan. That's not like some imagined thing. It's happening even right now. So that's the reason they're doing it, and it's no joke about it. A property is something. The thing I was going to say is a property is fine to live in, but property, the investment value property is completely hidden. I mean, you can't see the numbers. You don't see a number going up and down, but there is a number happening, and brokers know that. The best people who own property are the brokers. They make all the best money, have no risk. Just become a broker and just enjoy your life. That's the best thing to do.
Just run the numbers on it. If you run the numbers, you just think, okay, this is how much it costs, and you like it, go ahead. If you run the numbers but actually think, oh, it doesn't really work, as you do something different, then maybe you make a different decision.